Stock markets start 2024 with a bit of a hangover, and one company especially has a hard time with the new calendar year. My name is Daniel, and I will talk about that today on the long and the short of the markets, a weekly video about the stock markets and what's happening in the short term while putting it in a longer term context. You can get this video by subscribing to this channel or by checking out middlecoastinvesting.com, where you can get a text version as well. Market started this year slow. The S&P 500 dropped 1.5%, the NASDAQ and the Russell 2000 both dropped over 3%. I don't really see anything into it. There was not a lot of major news. The year usually starts slowly. There was a jobs report on Friday, which was pretty good. In theory, that leads to possibility that the Fed will be slower in cutting rates because the economy is still strong. I'm not really sure there was a lot into that. Markets actually rose on Friday, so that suggests that more than anything else, we had a reflex pullback. We see at the end of the year weird stuff happening, and I've talked about this around tax loss selling or not selling to keep gains. And it could just be that the new year starts as a reflex opposite of whatever the year ended. We saw a melt up to finish 2023. 2024, we start with a sell-off. And we'll see if it extends or if it's just the first week. Who knows? A lot could still happen. We had one specific company that sold off heavily, and I'm not talking about Boeing, which will probably have its own problems starting tomorrow. But there's a specific company also in the transportation industry loosely, and that's Mobileye. But before I get to it, I want to talk about why stocks sell off. There are a number of reasons that a stock might move on a given day. And those reasons I can put into a few different categories. One category is when a company has direct news. This is the most important in theory, but if the company releases earnings and they beat expectations or they miss expectations, or the company releases guidance, what it expects to earn or make in sales in the next quarter or the next year, that can have a fundamental direct effect. Maybe the company releases another type of news. It could have to do with acquisitions. It just could have to do with its performance, hire, whatever. There is specific news at the company. That's direct. Then there's news from other sources that is directly about the company. For example, there's sell-side ratings or analyst ratings. That could have a direct impact because a major analyst says this company is a buy, or it is no longer a buy. Now it's a sell. That's a direct news. A major investor could take a position in a company, or an activist could take a position. That's a direct news story. When a hedge fund releases a 13F, or when a famous investor like Warren Buffett, his company releases a 13F, that could have a direct effect because it's a sign that somebody has taken a position in that company, and that could mean so it's not coming from the company, but it is about them. Then we have some vaguer stuff. We have just momentum, gravity. It just seems like a stock. It had a good news report, it had a good earnings, and then there's nothing else to stop it from continuing to climb. That could be it. Algorithmic programs or machine programs start to factor that in, or quantitative measurements of a company's value adjust for that earnings report, and then it takes time to play out in the market. Could be something like that. Could just be that the market's up or down. It could be that a specific sector is in favor. There's rotation. Small caps do well today, or financials do well today, and so companies in that sector do well. All things like that can explain why in a given day a company goes up or down. They're vaguer, they're less harder to put your finger on. Then we get into murkier waters even with things like rumors, whisper networks, and so on. Alternative data, for example, credit card data shows that fewer people are buying video game systems, and that affects video game system makers. Things like that, that maybe advanced investors have access to and not everybody does, but then word breaks out, or you just don't really know. From a conspiracy perspective, there could even be leaks about acquisition talks or leaks about bad news, like the news we're going to hear about in a second. I don't subscribe to that directly, but stuff gets out there and perhaps news is made on that front. You can't really get your hold on it. The last type of news I want to talk about, because it's going to be what I talk about today to some degree, is read-through effects. That's where company X reports something and it affects companies Y, Z, A, B, and C because they're all related to that company in some way. So company X has a news that is good or bad, and that affects how these other companies are viewed because the market usually expects that, oh, if it's bad for that, it probably means that these other companies are affected. And I will say before getting into our actual topic that while I don't believe that markets are perfectly efficient, otherwise I wouldn't bother to invest in companies actively, the market is usually pretty good about making these categorizations. It usually does understand which companies go together, which effects actually matter for different companies. I was impressed, for example, with how the market understands that some banks benefit from higher interest rates while other banks don't and praise them appropriately, that sort of thing. It will often overdo these things and it will miss some things entirely. But when it usually creates these categories, there's a reason for them. Let's get into our example today, which combines both direct news with these read-through effects, which is the company Mobileye. Mobileye was the biggest story that I saw happening during last week. The company on Thursday put out a press release that mentioned its preliminary results for Q4 2023 and its guidance for 2024. The results for 2023 were more or less fine. As far as I could tell, it was a little bit ahead of expectations in terms of revenue and earnings. Not a major needle mover, but that's already happened. Its guidance for 2024 was the headline news, and it wasn't good. The company said that it expected to see sales drop in 2024 and losses, meaning bottom line losses, to increase materially from 2023. Mobileye is viewed as a growing company, a growth company, so it needs to be growing. Profitability in and of itself isn't bad, but if it's getting worse, that's also a bad sign. And this is all not good. Mobileye said most of the hit was going to happen in Q1, where its sales were going to be half of what it was in 2023. Again, bad. And then it said that it would grow in Q2 through Q4 as compared to last year, but only a little bit. Flat to single-digit growth, I believe, was the phrase they used. All of this is not what you want to see in your company. Mobileye hasn't been a profitable company since it returned to public markets in 2022, I believe. But it's a company that has been growing, and so seeing this material drop-off was a bad sign. Shares dropped more than 24% on Thursday. While it recovered a little bit on Friday, it still saw a $7.4 billion hit to its market cap, if I have the number right. That's a material hit for bad news that directly affected it. But as Mobileye sneezed, certain other companies caught colds. Let's go into whether it made sense that they got hit by looking a little bit more into who Mobileye is and why it had a bad report or a bad pre-announcement of earnings and guidance. Mobileye is a semiconductor company that makes chips for advanced driving assistance systems, ADAS, which is meant to help autonomous vehicles, essentially self-driving. When a car takes over, Mobileye's chips, system on chips, and so on will help in that effort. That's its aim. The company adds some software to it and doesn't describe itself as a semiconductor company, but it's owned by Intel, which is one of the biggest semiconductor companies in the world, and it works directly with semiconductor companies as suppliers before it sells into automobile companies. So I think it's safe to generally lump it in to the semiconductor category. I don't want to talk about autonomous driving or advanced driving because I don't know enough about it. I don't have a real insight into the industry directly at that level. So I'm not going to talk about its future growth prospects, but I do want to talk about what Mobileye said in its press release. I'm going to read it directly, the key sentences that may affect its business and other businesses. I'll also put it on the screen. We have become aware of excess inventory at our customers, which we believe to be 6 to 7 million units of IQ SoCs, system on chips. Based on our discussions, we understand that much of this excess inventory reflects decisions by Tier 1 customers to build inventory in the basic ADAS category due to supply chain constraints in 2021 and 2022 and a desire to avoid part shortages, as well as lower than expected production at certain OEMs, that's original equipment manufacturers, during 2023. There are a couple scary things in there, as well as a couple reasons to think that maybe this is a Mobileye problem. Scary thing number one, building up inventory due to supply chain constraints in 2021 and 2022. Investing in the 2020s has been a fascinating, challenging, and interesting opportunity rich time because the economy hasn't worked normally. Shutdowns, shortages, constraints, blockages, all these things that have prevented us from standard working order. And then you have all this pent up demand that gets spent and then exhausted. All this means that we can't build models, expectations, understandings the way we might normally. In the semiconductor industry, you might remember all the reports in 2020, 2021 about shortages that are preventing production, specifically of cars, even more than anything else. As supply chains and semiconductors were messed up, it slowed down production of things like cars and other goods because we use semiconductors more and more in those products. That led to opportunities for the semiconductor industry. It had a great 2021 as companies ordered tons of supply. And then in 2022, as demand was weaker, we saw the semiconductor industry struggle along with the market as a whole. 2023 was another strong year for the industry. A lot of that was due to AI and excitement over artificial intelligence and its need. But there was some of this still need for semiconductor chips in different products that boosted the industry. We'll talk about cars specifically in that context. But the fact that there was a buildup and now we're seeing, oh, we've actually built up enough, and now that we can expect to order at a normal time, that means you're going to see a quarter or two where companies have to clear their inventory and where the suppliers of that inventory are going to struggle. At least that's what we're seeing in this case with Mobileye. If that's a wider issue, that could be scary for semiconductors as a whole, depending on how far we go. Let's get to the second scary thing. Lower than expected production at certain OEMs during 2023. This is more localized in theory to the auto industry, but if original equipment manufacturers, OEMs, are producing fewer cars than they're expected, that's going to affect all the suppliers to cars. Semiconductors have grown in cars both because of electric vehicles and their needs and the electronification of vehicles, the touch screens, the other things on the dash that have changed, and these driver assistance tools and other things that will require semiconductors to function so that you can see that where you're backing into and so on. All of those could be a problem, are used semiconductors, and thus could be a problem for those semiconductor companies if the automotive industries have built up a ton of supply so that they don't need to order fresh chips in the next quarter or two. This could be a more localized thing to Mobileye. Let's go into two reasons why. One is that Mobileye makes these ADAS tools, advanced driver assistance systems. It could be that that's a very specific product. I don't know who exactly Mobileye is competing with, who else supplies these direct types of chips. And so it's possible that this is just a Mobileye thing. I have a little bit of a bias. My one direct experience with using a Mobileye product in a car was when I rented a car sometime in 2017 or thereabouts, and I was ready to take a baseball bat to the thing by the end of the week. So I haven't seen the utility in this. I drive a relatively old car, 2011 or 2012. I could be missing out, but it's possible this is a Mobileye problem. The other thing here is that it's worth remembering that there was a United Auto Workers strike last quarter, started in September and extended into October, I believe. That could have crimped production. That could be part of what we're seeing. There's some lag in the need to produce new cars because they didn't produce as many. I don't know. All that said, Mobileye's sell-off was bad for it, but we did see other companies that caught a cold. Let's talk a little bit about them and what we can learn about the read-through effects here. STMicroelectronics is one of the most obviously affected companies, and it's no surprise that its shares sold off 5% in the 2 days after this news. 45% of his business is to automotive industry companies, so it's directly affected from its business line, but it's also Mobileye's direct supplier for its system on chips system. So if Mobileye is struggling, that's going to affect STMicro. Correct read through, all things being equal. We don't know everything here, but it makes sense that it would be hit. Another company is onsemi. Onsemi's business has boomed in the recent years as the automotive industry has demanded more and more of its chips. For context, its shares closed the week at about $75 a share. I was happy to buy shares at $7 a share about a decade ago and sell them in 2015 for $12 a share. Obviously, I missed out on big move, most of which has happened in this decade, in the 2020s. onsemi sold off, my number is 4.5% last week. It had also sold off quite dramatically, 22% in October at its Q3 earnings report, when its Q4 guidance was weaker, which it attributed to European car makers working through inventory and single automotive OEMs reduction as reasons that it wasn't going to hit its numbers for the rest of the year. Mobileye, by the way, sold off 3.5% that day, another read through in the other direction. So it makes sense that onsemi would be directly levered to automotive demand for chips in cars. And if Mobileye is struggling, onsemi might have the same problems. That's another read through effect. A different type of read through effect that we didn't see happened with Intel. Intel bought Mobileye in 2017 or 2018, owns 88% of the company still, if I'm not mistaken. And so, in theory, its stake lost $6.5 billion in value, which would amount to 3% or more, a little bit more than 3% of Intel's market cap. And yet, Intel sold off less than 0.5% in those 2 days. For whatever reason, the market didn't think that this was a big problem for Intel. Mathematically, that would seem to be incorrect, but there's no real way to take advantage of this. And so it's not really worth worrying too much about. It's just an interesting case of a read-through not happening. I want to talk about one last read-through because this is a company that's in my portfolio and that I took action on as a result of this, and that's Axcelis Technologies. Axcelis Technologies is one step higher up in the supply chain, further away from the automotive companies, because it sells to semiconductor makers. Basically sells ion beam laser type equipment so that these semiconductor makers can make their chips more efficiently. And it's done very well due to the demand for power chips or silicon carbide chips, which go into these cars, among other products, other machines. Axcelis sold off when the On news came out back in October, but then they said, actually, we're not really seeing any problems. We still expect to hit our targets for 2025. We still expect 2 years of growth. We feel fine for this year. We're not seeing the direct problems that On see. It could be because one of Axcelis' biggest risks actually played out in its favor. It sells quite a bit to China, which is a risk because at some point the US government might say, we're not allowing you to sell semiconductor equipment to China. But it diversifies their revenue away from the US, Europe automakers that may be more directly a part of Mobileye or onsemi's business, though both companies do sell to China as well. So I'm not sure about this. But in any case, Axcelis, for whatever reason, is still seeing good demand, at least as of a couple months ago. It sold off more than 4% on Thursday before recovering somewhat on Friday. And again, we'll see if it's a direct impact. I, for the first time in 15 months, bought shares in Axcelis on Thursday. Axcelis had a huge 2023, at least first half of the year. The first 7 months, it rose over 200% and over 300% in the last 9 months leading up to July. It then pulled back over 35%. And I wrote in my year-end letter that it was just starting to look interesting again for the first time in 15 months. I bought shares, and now I'm taking on the risk that, yes, maybe this cold that Mobileye has is contagious and is going to affect Axcelis' business. But my hope is that it's a little bit more immunized, a little bit more vaccinated from this problem because it's a little bit higher up. It has exposure to other parts of the chip industry. Memory chips, for example, is expected to recover in the second half of this year, which would help Axcelis a decent bit as that happens. And so I'm trying to take advantage of a read-through effect that I'm hoping is overdone. Now, I follow the market pretty close. I'm a professional investor. I don't have enough of a day life to avoid looking at the computer. So I get really geeked into these things. Really, if you're following the markets less closely, if you're just looking quarter to quarter at a company's earnings and you're following, is the earnings trajectory looking good over the long term, you're not going to pick up on all these different effects, all these different whispers, rumors, read throughs, and so on. You're just focused on that first effect, which in theory is the most important. And I think that's a healthy way to approach things. But if you are more excited about following the market and you want to get into these different things, you may have the chance to see red flags arise before it is directly in your company's news, or you may have the chance to see opportunities where the market is a little bit too quick to sell off shares of a given company because of the read-through effects or whatever else. In this case, we've seen how an issue with Mobileye has flowed on to several other companies, and I'm hoping for an opportunity out of this news, though really I'm more focused on the long-term earnings trajectory of Axcelis, and I was planning to buy at those shares that share price anyhow. It's just that Mobileye was the last push that got shares to where I was ready to buy. We'll see whether I get sick from this move or whether I come out the other side stronger than ever. That's just an example of how stocks move, how you can take advantage of looking at things closely, and it was the most interesting thing that I saw in the markets last week. That's it for this long and short of the markets. Again, my name is Daniel. You can check out middlecoastinvesting.com for my registered investment advisory business. You can also check out shortinvestingguide.com, where I'm building a guide about longer term investing. I have a couple new videos that are going to start coming out again this week or next, so stay tuned for that. Thank you so much for watching, and I hope to see you next time.